You are listening to The Vocal Technologist. Spoken Tech for your ears.
What if a piece of software could, negotiate a deal, sign the contract, and then just pay for it out of its own digital wallet, all while you are fast asleep?
Yeah, that sounds completely absurd. Like some discarded script from a sci-fi film about the future of commerce?
Right, it really does. But here's the truly wild part. That is the exact financial infrastructure being built right now. So we are going to unpack the quiet but massive rewiring of global money.
It is a massive shift.
Mhm.
We are looking at how financial technology is evolving from just simple apps on your phone to autonomous economic actors.
Exactly. And we really want to explore what happens when machines actually start carrying the wallets.
The evolution is fascinating, but before we look under the hood at robots spending money, we really have to understand the battle for the human consumer.
Because the apps you already use are aggressively expanding their territory.
Spot on. They are setting the foundation for everything that comes next.
Well, let us get straight into that consumer front line. Because Robinhood, for example, is moving far beyond simple stock trades. They are launching a $695 Platinum card.
Yes, targeting tech-savvy consumers with massive cashback rewards.
Right, directly challenging premium stalwarts like American Express and Chase. And it does not even stop there. Robinhood is also making a huge bid to become a multi-generational family finance hub.
Yeah, adding custodial accounts for children,
Yeah.
gifting features.
I have to say, Robinhood trying to become a respectable family financial hub is a bit like a rebellious teenager suddenly deciding to run for local council. It's quite the pivot.
It is a full-on pivot, but I mean, the unit economics make perfect sense. Consumer finance is just incredibly sticky.
How so?
Well, if a platform can capture the financial relationship of a child through a custodial account and have your whole family gifting into that portfolio, they lock in a customer for decades.
Because the assets automatically transfer when they reach adulthood.
Exactly. It is no longer just about capturing a single day trader. It is about capturing the entire household balance sheet before traditional banks even get a foot in the door.
Speaking of capturing consumers, Klarna just smashed past the milestone of 1 million merchants globally.
1 million is a staggering number.
It really is. And they grew their merchant base by 47% in a single year. And the data backs up why merchants are flocking to them. By now, pay later usage has surged to 37% of consumers.
But here is the detail that really stands out. Traditional banks are surprisingly beating the pure financial technology providers in customer satisfaction for these installment payments.
Yeah, that made me pause too. Why are the legacy banks winning a game they did not even invent? I mean,
Okay.
they are beating the innovators at their own game.
It mostly comes down to friction and an existing trust. Traditional banks hold the primary credit relationship. They own the primary banking app on your phone.
Right.
So when a legacy bank embeds an installment option directly into a checkout experience using a credit card you already hold in your wallet, the friction is virtually zero.
Because you do not need to download a new app or pass a new credit check.
Spot on. The challengers pioneered the model, but the legacy banks are weaponizing their massive distribution channels to just take it over.
Which actually explains a very strange regulatory push we are seeing. Digital lending companies are actively lobbying state legislatures to adopt a 36% interest rate cap.
Yeah, they want to standardize lending rules nationwide.
Wait, why on earth would lenders actively ask the government to cap their own rates? That seems backwards.
Because scale requires certainty. Operating a national digital lending business across a messy patchwork of different state regulations is just an absolute compliance nightmare.
So federal efforts to impose a national cap stalled out, and now these companies are going state by state.
Exactly. A uniform 36% cap clarifies the rules of engagement. It allows responsible digital lenders to build their algorithms and scale operations without constantly tripping over contradictory local laws.
We are also seeing a massive push in how your financial data actually moves around. Truist has tapped Plaid to expand open banking, giving consumers smoother logins and way better data control.
Open banking is essentially the invisible plumbing of modern finance. When you link your budgeting app to your bank account, you are not handing over your password anymore.
You are using a secure, tokenized bridge.
Right. By partnering with Plaid, traditional banks are finally acknowledging that you, the consumer, expect your account to connect seamlessly with outside investment tools and payment platforms.
And all those transactions you make, every time you use open banking or tap a card, you are not just moving money. You are printing structured data,
Heaps of it.
which creates the perfect training ground for our next massive shift, injecting artificial intelligence directly into the advisory and security layers of finance.
The sheer volume of structured financial data we are generating is unprecedented. And the tools required to analyze that ocean of data are, well, they're finally becoming conversational.
This actually brings me to a detail that I genuinely found hilarious. Experian has launched a credit score comparison tool natively inside ChatGPT.
Oh, wow. Yeah.
You can benchmark your scores using conversational AI rather than, logging into a traditional banking interface. Wait, why would anyone casually ask a chatbot for their credit score instead of just opening their banking app?
I reckon it is because many consumers, particularly younger demographics, find traditional financial portals intimidating and clunky.
It feels like turning a boring financial spreadsheet into a highly caffeinated financial advisor who actually speaks your language. Does this make the traditional banking app completely obsolete?
Not obsolete, but it is a wake-up call. Experian is simply meeting the user where they already spend their time. The integration takes anonymized data and gives you local benchmarks.
Oh, explaining your financial standing in plain English without the jargon.
Exactly. If you are listening to this and wondering why your banking app feels 10 years out of date, this is why. If a third-party artificial intelligence can explain your finances better than your own bank, the bank loses that primary relationship.
And it is getting even more sophisticated. Perplexity has introduced an AI investing dashboard that links to personal brokerages via Plaid.
It is full on. It combines your retail holdings with institutional data from S&P Global and SEC filings to answer really complex portfolio questions.
This completely democratizes institutional-grade analytics, right? Previously, only professional traders with expensive terminal subscriptions could instantly cross-reference a personal portfolio with live corporate filings.
Or check for sector concentration risks. Now an automated agent does the heavy lifting, synthesizing your personal data with macroeconomic trends.
Though it stops short of actually executing trades to avoid massive regulatory hurdles, I assume.
Spot on. But the analytical power handed to the everyday retail investor is just immense.
MasterCard is taking a completely different route to harness all this data, though. They are building a large tabular model with NVIDIA and Databricks.
Training it on billions of anonymized structured transactions.
Right, to improve cyber defenses and loyalty programs. Let us pause here for a second because we hear about large language models constantly.
We do, yeah.
Explain what a large tabular model is and why MasterCard needs one.
Well, most artificial intelligence we interact with relies on large language models, which are trained on unstructured text like books and articles. But financial data does not look like a book.
It is structured.
Exactly. It lives in massive spreadsheets of rows and columns. A large tabular model is specifically designed to understand the complex mathematical relationships within those huge data sets of transactions.
Ah, so a language model might write a great email, but a tabular model is incredibly effective at spotting the subtle mathematical anomalies that indicate fraud before a transaction even clears.
You nailed it.
So traditional banks are facing mounting threats from these tech-native firms and AI-driven advice. They are being forced to choose between being digital gatekeepers or asset-light orchestrators. Sitting still is clearly no longer an option.
Absolutely not. But while you and I might willingly invite AI into our personal portfolios, the corporate world operates quite differently.
Yeah, down in the enterprise layer, massive financial forces are literally buying their way into corporate infrastructure.
The strategy at the enterprise level is all about forced distribution. Getting massive established corporations to adopt new technology is notoriously slow.
So the leading artificial intelligence labs have found a multi-billion-dollar shortcut.
They have. OpenAI and Anthropic are aggressively courting massive private equity firms like Blackstone, TPG, and Bain Capital.
Wait, they're creating joint ventures where the private equity firms get board seats and equity?
Yes, and in return, they act as distribution channels to force enterprise AI into all their portfolio companies.
Okay, I have to push back on this. Corporate IT departments are notorious for killing new software integrations. So how can a private equity board member actually force an IT manager on the ground to use Anthropic without breaking their existing security protocols? I mean, are these buyout firms basically acting as a $10 billion sledgehammer to smash AI into stubborn corporate IT departments?
Yes, they absolutely are.
Yeah.
And it works because of the power dynamic. These private equity firms own hundreds of companies across every sector of the economy.
Right.
When the directive comes directly from the ownership demanding productivity gains and cost reductions, the usual corporate IP resistance just crumbles.
It is top-down implementation on an industrial scale. The AI labs bypass the traditional multi-year enterprise sales cycle entirely by partnering with the ultimate bosses.
Exactly. But despite this aggressive push, legacy platforms like SAP persist because they hold the canonical institutional data.
So the goal is not to replace them, but to use AI as a programmable system of action sitting on top of the legacy system of record. Explain that dynamic to me.
Well, ripping out a legacy platform like SAP or Salesforce is a logistical nightmare that most companies refuse to undertake. It holds all the critical permissions, workflows, and historical data. That is your system of record.
Okay.
So the enterprise strategy has evolved. You leave the ugly, complicated legacy database in place. Then you build a sleek automated agent on top of it.
The artificial intelligence becomes the system of action, executing tasks and interacting with the human workers, while quietly updating the old legacy database in the background.
Spot on. Because modernizing those mission-critical financial systems is brutally complex.
American Express demonstrated this by migrating their global payments network twice with zero downtime using microservices and canary routing. I mean, replacing a legacy corporate software system like that is exactly like trying to swap out the engine of a commercial airliner while it is cruising at 30,000 feet.
That is the perfect analogy. It is a monumental engineering feat. They took their massive monolithic system and break it down into smaller, independent microservices.
And canary routing is the key here, right?
Yeah, it means they diverted a tiny, microscopic fraction of live transactions to the new system to test it, like a canary in a coal mine.
Once they proved it worked flawlessly, they slowly dialed up the volume.
Exactly. It requires incredible observability and the ability to instantly roll back if a single transaction fails.
And the corporate financial environment they are operating in is highly volatile right now. The SEC is even considering making quarterly earnings reports optional, reducing them to twice a year.
Which is a huge shift. Proponents argue this would stop public companies from obsessing over short-term quarterly targets and allow them to focus on long-term growth.
But the trade-off is pretty severe. It means investors would have significantly less visibility into the financial health of public companies, creating much longer periods of uncertainty and speculation in the markets.
Concurrently, JP Morgan has had to mark down the value of some private credit loan portfolios due to software sector risks. It shows just how interconnected tech valuations are with traditional banking risk.
Private credit just exploded during the era of cheap money, right? Providing massive loans to software and tech-native startups.
Yeah, and as economic realities shift and software revenues face pressure from automation, the underlying loans become way riskier. JP Morgan marking down these portfolios is a clear signal that risk models across the entire banking sector are being drastically recalibrated.
So once artificial intelligence becomes the dominant system of action in the corporate world, it hits a massive brick wall. It cannot actually execute a transaction.
Right.
Which brings us to the most fascinating part of this discussion. This limitation is exactly why the biggest tech companies are frantically building infrastructure for machines to spend money. Welcome to the era of machine commerce and robot money.
Think about the workflow. If an automated agent can negotiate a contract, manage a global supply chain, and optimize warehouse inventory, but still have to send an email to a human being to click approve on a $50 invoice.
The entire automated efficiency just breaks down.
Exactly. The friction of human approval becomes unacceptable.
Amazon Web Services is partnering with Visa to leap into agentic payments. They're creating network-agnostic workflows so shopping assistants can autonomously make purchasing decisions and execute payments.
They are building the underlying rails for autonomous commerce. This means an assistant can securely access your payment credentials and interact across existing global payment networks without you needing to authenticate every single purchase.
It combines massive cloud computing infrastructure with the advanced fraud detection we discussed earlier to ensure these autonomous transactions are actually legitimate.
We are also seeing new blockchains built exactly for this purpose. Tempo, which is a blockchain project incubated by Stripe, has launched an open standard protocol specifically designed for machine-to-machine payments.
Wait, why build a new blockchain instead of just using the existing SWIFT banking network?
Because traditional banking rails are slow, expensive, and crucially, they require identities tied to human beings or registered corporations. A piece of code cannot walk into a bank branch with a passport.
Of course. So a blockchain protocol like Tempo provides an open standard where an autonomous agent can have a verifiable digital identity and settle transactions instantly, globally, for fractions of a cent, entirely outside the legacy banking system.
Spot on.
The concept of robot money is really emerging as platforms attempt to build companies run entirely by code with minimal human oversight. These autonomous agents require their own treasury protocols to hold digital wallets and deploy capital. I have to express genuine skepticism here.
I'm sure you do.
Giving an autonomous agent its own digital wallet feels exactly like handing a toddler a limitless credit card in a massive digital candy store. How can any regulatory body possibly govern an economy where half the participants do not need to sleep, breathe, or ask for permission?
Well, you have identified the defining regulatory challenge of the next decade. How do you apply Know Your Customer regulations to 1,000 lines of Python code?
Right. If an autonomous agent commits financial fraud or buys illicit goods, who is legally liable? Is it the developer who wrote the code, the cloud provider hosting it, the user who deployed it?
Exactly. The Treasury protocols being proposed would allow agents to manage idle capital and earn yield completely detached from human financial tools. Our current regulatory frameworks simply were not built to govern non-human economic actors.
To support this borderless machine economy, stablecoins are completely rewiring global finance. MasterCard is acquiring stablecoin infrastructure startup BVMK for up to $1.8 billion to link traditional payment rails with blockchain. Before we move on, explain to me what a tokenized deposit actually is and why MasterCard is spending over $1 billion on it.
A tokenized deposit is essentially a digital claim on a real fiat currency, like a US dollar, held securely in a traditional bank.
Okay.
But because it is tokenized, that claim can move across a blockchain at the speed of light 24 hours a day. International payments have historically been slow, fragmented, and expensive because they rely on correspondent banks manually updating ledgers.
So MasterCard making a $1.8 billion acquisition signals that tokenized deposits and stablecoins are moving from the speculative fringes of crypto into the absolute core of how global payment networks will operate.
Absolutely.
And Tether, the massive stablecoin issuer, is generating so much cash, it's practically becoming a venture capital firm.
Tether holds massive reserves of U.S. Treasury bills to back the value of their stablecoin. With interest rates relatively high, the yield they generate on those tens of billions in reserves is astronomical.
Wow, so they are taking those massive profits and deploying venture capital across the huge range of industries, effectively acting as a major liquidity provider completely outside the traditional banking ecosystem.
Yeah, it is wild. Simultaneously, traditional financial technology companies are racing to build their own borderless infrastructure. Airwallex is pouring $1.1 billion into European expansion, while Ramp is entering Europe by acquiring Billhop.
Why acquire a company just to enter a market, though?
Because expansion requires regulatory authorization in every single new jurisdiction, which can take years. Ramp acquiring Billhop was a strategic move to instantly gain the necessary payment licenses to operate across the entire European region.
So Airwallex committing over $1 billion shows the massive pent-up demand from modern businesses needing multi-currency payment platforms to operate globally without friction.
Exactly.
So we have basically widened the financial pipes to handle flawless, instantaneous digital money for both humans and machines. But widening the pipes inevitably creates massive new vulnerabilities and entirely new classes of bad actors. Let us explore the dark side of all this innovation.
Yes, whenever you increase the speed and volume of money movement, you proportionally increase the surface area for sophisticated fraud.
Global fraud losses have surged to nearly $580 billion, and over $14 billion of that is directly tied to AI-driven scams using highly convincing phishing and automated interactions.
We are locked in a vicious, escalating arms race. Criminals are using generative models to clone voices, draft flawless phishing emails, and automate millions of social engineering attacks simultaneously.
So financial institutions are forced to deploy equally sophisticated models just to detect the subtle, non-human patterns of these automated attacks. We have reached a point where it is machines fighting machines over human money.
Spot on. And the institutional risk is massive. JP Morgan is facing a lawsuit from investors for allegedly enabling a $328 million crypto fraud tied to Goliath Ventures by ignoring warning signs.
Banks have a strict legal obligation to monitor accounts for suspicious activity, right?
They do. When massive frauds occur, the victims inevitably target the deep pockets of the institutions that provided the banking infrastructure, arguing they should have detected the anomalies. It really highlights the immense existential liability banks carry when dealing with high-velocity digital assets.
Then we have the absolute boom in prediction markets, like Polymarket and Kalshi. They have birthed what is being called the everywhere insider. Access to non-public information like unreleased creator videos or leaked corporate audits is being actively monetized.
This is a fascinating and terrifying evolution of risk. Traditional insider trading laws apply strictly to financial securities like stocks and bonds.
Right.
But prediction markets allow people to bet on cultural events, YouTube views, or political outcomes. If you are a video editor for a massive content creator and you know a highly anticipated video is going to drop tomorrow, you can monetize that leak on a prediction market.
It turns operational gossip and basic corporate leaks into a highly liquid tradable asset class. That is incredible. And Kalshi has even integrated Cash App Pay, connecting these prediction markets directly to 59 million mainstream retail users.
The friction to enter these speculative markets is just vanishing. Integrating natively with an app used by tens of millions of people means anyone can instantly fund an account and start trading on real-world events straight from their couch.
These prediction markets are also creating dangerous incentives where traders attempt to manipulate journalists who serve as the media oracles resolving the market outcomes. Plus, we are seeing complex special-purpose vehicles offering exposure to private tech giants plagued by opacity and outright fraud. Let us pull apart special-purpose vehicles for a second. These are basically pop-up shell companies created to pool money from smaller investors to buy shares in a private giant like SpaceX, right?
Exactly. But because they operate in private markets, they are highly unregulated. The person running the special purpose vehicle can charge massive hidden fees or completely obscure what underlying assets you actually own.
So investors are pouring money into these layered funds just to get exposure to the hype, often without any real guarantee they own the underlying shares. The opacity is a perfect breeding ground for exploitation.
It really is.
So between unregulated special-purpose vehicles and prediction markets, we have essentially crowdsourced insider trading. If an anonymous video editor can make a fortune betting on a YouTube view count, have we fundamentally broken the concept of financial market integrity?
It forces us to entirely redefine what market integrity means. When the outcome of a highly leveraged financial contract relies on a media report or a social media post, the financial incentive to hack, bribe, or manipulate the journalist writing that report becomes overwhelming. We are applying financial market mechanics to aspects of reality that were never meant to be traded.
Imagine a near future where your personal automated assistant not only manages your entire portfolio, but actually has a significantly better credit score than you do.
It is a wild thought, but it really is not that far off.
Keeping you ahead of these bizarre tech curves is exactly what we do here on Vocal Technologist. It leaves you with one big question to ponder as we wrap up. When the code eventually asks for its own bank account, are you ready to hand over your wallet to the machines?
Spoken Tech for your ears.